Welcome. My name is Travis Clark, and I am a U.S. economist at Visa. Today, we are going to explore what is ahead for the U.S. economy in 2024, and I'm joined by Visa's Chief Economist, Wayne Best, and our Principal U.S. Economist, Michael Brown. Before we get into our outlook for 2024, though, I think it's worth looking back a bit at 2023. We had a year that was characterized by big, positive surprises. So, Wayne, if you had to sum it up, what was the biggest surprise to you this past year?
I think the resilience of the consumer really stands out. I mean, despite the fact that we had high levels of inflation, despite high interest rates, the consumer kept spending.
Yes. And Michael, what about you? What surprised you the most?
Well, I would say it was really the driver of consumer spending, which is the robust labor market. We've been surprised month after month at both the robustness of job growth and wage growth this year, which I think gave the rocket fuel for that consumer spending growth Wayne mentioned.
Yeah, I agree with both of those. I would just add that this time last year, we weren't expecting international trade to be such a contribution to GDP growth, and that really surprised me. So let's turn to 2024. Wayne, how would you characterize the economy coming next year?
Well, I think we are looking at a slowdown happening in the first couple of quarters of the year. Whether it's called a recession or not, I think will be decided later, of course. But the bottom line is we are going to see slower levels of growth as demand starts to pull back a bit. There'll be some job losses in the first half of the year. But as we get into the second half, with the interest rates starting to come down by the Fed, I think that will start to fuel growth again. And I think it could be a very short slowdown with a nice robust finish to the end of the year.
Great, yeah. And Michael, can you walk us through some of the key themes that are going to motivate growth next year?
Well, our team really boiled the contours of growth for next year down to about 5 key factors. The first of these is that we finally think inflation will get back to the Fed's 2% target. Wayne mentioned interest rate cuts. With inflation coming down, we think monetary policy, those Fed rate hikes, are probably over, and we're staring down the barrel of potentially some cuts from the Federal Reserve. That's going to be additive to growth in our perspective. As we think about sort of the weak link in GDP growth, we think it might be on the business side of the economy. As Wayne mentioned, we're probably dealing with a high rate environment for the first couple of quarters. That's likely to slow business and specifically small business investment. As we think about the consumer piece in our fourth theme, it's really about focusing on the affluent consumer. We think they're going to be the real driver of growth, particularly through the first 6 months of next year. And finally, rounding out our fifth theme, it's really a function of politics becoming more political in 2024 with an election year on the horizon.
Okay, well, let's start unpacking these. Wayne, can you start us off with their first key theme, which is our inflation outlook?
Yeah, so we look into next year, I think we're going to see some differences, again, between the first and second half of the year. Prices are coming down. We saw this in 2023, but specific categories are really starting to drop. And that's going to play very prominently in the outlook as we see it for inflation. Durable goods, things designed to last longer than 3 years, are really in disinflation, in many cases deflation. I mean, you've probably seen it during Black Friday sales, et cetera. We now have 77-inch TVs that we didn't think we needed. But those prices have come down quite substantially. Now, I'm not saying that inflation's fully under control yet. I mean, there are things like food, et cetera, that is still quite high. But this is a positive movement as we look into the first part of the year. Now, another way to look at this is what's happening with retail profit margins. They're really under pressure. And frankly, that's a great sign to follow because it is an indicator of where inflation's likely to end up in the short term.
Wow, I mean, I think this actually leads us nicely into our second key theme, which is that interest rates are likely going to be coming down next year. Michael, can you expand on what the Fed is motivated by in bringing those down, and also the implications for the yield curve and interest rate sensitive sectors?
Well, there's a lot to unpack there in that question, but I think let's start with sort of the contours of the interest rate cuts that we're expecting. Like I mentioned, no real interest rate changes in the first 6 months of the year, but we think starting in June, we're likely to see about 25 basis points cuts per meeting through the end of the year. It'll take our federal funds rate right around 4.25% by the end of the year. So that's much more conducive to sort of lending and frankly spending as it relates to sort of the interest rate environment. Now, you mentioned the yield curve. We know that markets tend to move ahead of the Fed just a little bit, and so we think leading up to June, we'll see that steepening out of the yield curve. That will allow the lending environment to start freeing. It's a little more profitable to lend when there's an interest rate spread in that equation. So,
Absolutely. And moving along to our third key theme, which is something that I've been watching particularly closely, which is that business investment is likely to be the weakest link next year. Now, given what you were just talking about, I think people are going to be a bit surprised to say that we're looking at slower business investment next year. But why don't you let us know what exactly is motivating our outlook for next year on business investment and why it's the weak link?
well, I think weak link, it's mostly a first half of next year's story with that high rate environment. As a business person, we're always looking at the return on investment, and that math is less favorable in a very high interest rate environment. So we think when lending comes back, that's likely to stimulate some of this spending on the margin, likely a second half of the year story, as Wayne mentioned. Now, the other dynamic is the small business sector really relies heavily on credit. And the availability of credit, well, frankly, isn't really there right now for the small business side of the economy. We expect that to weigh on business investment, and that's going to take just a little bit longer to rebound next year than the overall large business environment. So, all in all, it's the weakest link, but again, it doesn't mean that we're looking at falling off a cliff in terms of investment. It's just a slower growth environment for the first half.
Well, that's good to hear. So switching gears from the business side to the consumer side, our fourth key theme is that the affluent consumer will become more influential. Now, this year for the consumer in general, resilience has been a very positive surprise, but we definitely see some headwinds going into 2024. Wayne, why do you think the affluent consumer will be able to weather the storm better, so to speak?
So, I think to unpack the spending picture, you have to look at what drives spending. And what drives spending, of course, is how much money we make. Real disposable income is expected to fall next year in the first part of the year. And that's multiple factors behind that, but it's one, a slowing economy, as I talked about, but also related to what were expectations for unemployment growth and where we see that by mid-year. So if that's going to fall, we're going to likely see a slower level of spending overall for the economy. Now, unpacking that relative to the affluent, if we think about the things that are nice to have, discretionary purchases, travel, etc., those are going to be a little bit more resilience for the affluent. And why? Because they've got a lot of excess savings still. And so they can still draw upon that to basically maintain the level of travel that they did next year, maybe even increase just a little bit also. So those are the factors. Now, there are some stumbling blocks that are potentially out there. The risks include, if we have further outbreaks, let's say in the Middle East, which causes security issues and travel starts to cut back. And even if we see some imbalances in the stock market or even the housing market, that wealth effect can truly impact affluent spending very directly. So those are the different levers that we're following very closely. And I think affluent will indeed be a big part of the influence that we see in the economy next year.
All right, so our final key theme for 2024 is that we expect politics to become a little more political next year. Michael, what exactly does that mean in the context of our economic outlook?
Well, I'd break it into two broad buckets. First of all, we have the election. So we have the House of Representatives and about 34 senators up for re-election, including the presidency. So as we think about marching towards the fall, it's really going to be a focus on consumer confidence. Our analysis shows that there's really not a major real economic impact in an election year. It's usually the year following the election. But the true story is, what's really going to be the economic policies going forward? That's going to create some uncertainty with an unknown election outcome for both Congress and the White House. The second sort of piece of this political angle is that we've got some uncertainty with the current Congress with respect to sort of keeping government funding beyond a couple of deadlines that we have in the first quarter of next year. So the big question is, will they kick the can, keep funding the same? That's a recipe for not adding a lot to economic growth in the year ahead, at least relative to what we've seen in federal spending this year. So again, Lots of uncertainty, that polarization, that politics is likely to be a level of economic uncertainty that we haven't seen, well, frankly, since the last election.
So I think to sum up our 2024 outlook, it seems like we'll have a year that simply meets expectations rather than surprises like last year. So thank you, Wayne, and thank you, Michael, and thank you for tuning in. For more great insights, I encourage everyone who has not already to please subscribe to visa.com/economic insights. For all of us here at Visa's Business and Economic Insights team, we want to wish you the best in the year ahead.